How many day trades can you make on Robinhood? On Robinhood, the number of day trades you can make is governed by the Financial Industry Regulatory Authority's FINRA Pattern Day Trader (PDT) rule, which applies to accounts using margin. If you execute 4 or more day trades, buying and selling the same security within a single trading day, over a rolling 5-business-day period, and those trades make up more than 6% of your total trades in that period, you are flagged as a pattern day trader. This designation imposes a strict requirement. You must maintain at least $25,000 in equity in your margin account to continue day trading freely. Without meeting this requirement, your account may face restrictions on trading activities, often limiting you to closing positions only. For accounts not using margin or those under the $25,000 threshold, the rule significantly limits the frequency of day trades. If flagged, additional trades may be blocked, and some users report frustration when unknowingly triggering the PDT rule. The rule aims to protect inexperienced traders from excessive risk-taking, which is common in the fast-paced world of day trading. However, it also creates barriers for casual or small-scale traders who might want to execute more frequent trades without committing a large amount of capital. A key advantage of the rule is its role in risk management. Day trading is inherently volatile and speculative, with statistics suggesting that the vast majority of day traders, up to 95% by some estimates, fail to achieve consistent profitability. The equity requirement ensures traders have enough capital to withstand the rapid gains and losses typical in this strategy. Moreover, margin accounts, by design, allow leverage, amplifying both potential profits and risks. For traders prepared with adequate funds, the rule encourages disciplined trading and prevents unchecked losses. However, the disadvantages are equally significant. The $25,000 threshold excludes many beginners and small-scale investors who lack the financial means to meet the equity requirement. This limitation can feel particularly frustrating for those who wish to hone their skills through small trades. Furthermore, the rule disproportionately impacts active traders with small accounts, potentially stifling opportunities to experiment with different strategies. Critics argue that this creates a barrier to entry in a market that promotes democratized access to investing. Robinhood and similar platforms do offer some workarounds. Traders can consider alternatives like cash accounts, which are not subject to the PDT rule but have delayed settlement times, usually 2 business days, reducing the frequency of possible trades. Another option is spreading trades across different brokerage accounts, though this approach requires careful planning and is less convenient. Additionally, some traders focus on swing trading, where positions are held for longer periods, circumventing the need for same-day transactions. In conclusion, while Robinhood provides accessible tools for trading, users must navigate the constraints of the PDT rule carefully. For those with significant capital and experience, the rule offers opportunities to trade actively while maintaining safeguards. For smaller or newer investors, it necessitates strategic planning and disciplined trade management. Understanding these dynamics is essential to making informed decisions and aligning your trading approach with your financial goals.